Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name is Manpreet and welcome to Cut to the Chase. Now it's a gloomy morning in Singapore with most of the skyline covered in threatening dark clouds. That just about sums up the mood in markets yesterday, with worries of an economic recession in the US dominating the narrative. While this is less of a direct concern for US equities, which did stage a rebound after opening week, there are two specific indicators I wanted to focus on today. The first is the US yield curve, specifically the gap between the 10-year and 2-year government bond yields. Now, this gap turned negative yesterday, which is significant because, as many of you already know, this yield curve is one key indicator of a potential US recession. Now, no indicator is perfect, so it does come with two specific caveats. The first is that while it has inverted before every US recession, it has also provided false positive signals before. Second is that it is less specific in terms of timing, with one study by the San Francisco Fed noting recessions occurred anywhere from 6 to 24 months after inversion, which is a pretty wide gap from an investor's point of view. There's also the matter of how long it stays inverted. Regular listeners will know this is not the first time in the current cycle that this indicator dipped into negative territory, but the move was previously not sustained beyond a few days. Now, we are ourselves of the view that recession risks are rising in the US, a view we discussed in our second half Outlook mini-series podcast. Have a listen to those if you have not done so already. However, we'd favor a broader approach to watching recession risks because no one indicator is perfect. Our own recession checklist incorporates many other factors, including consumer and business sentiment and other market indicators like credit spreads, as well as the 10-year, 3-month yield curve, which we'd argue is a slightly better track record in terms of timing. Now, investors, of course, will need to balance our view of rising recession risks against a judgment of how much may already be priced by risky assets, as well as the fact that no one indicator offers certainty. We believe a second half outlook view to add to bonds at the expense of equities is one route by which investors can mitigate this risk. Recall that usually during downturns or recessions, bond yields fall, in other words, bond prices rise, a relationship that is now beginning to reassert itself after breaking down the first half of 2022. Now, a second and related area I want to draw your attention to is the US dollar. Now, yesterday, the DXY dollar index broke above the recent high of 105.8 as recession fears dominated. Now, regular listeners will recall that this level was one key technical indicator we'd watch for in terms of whether the dollar rally had further to go in the short term. Now, full year views notwithstanding, this break above the 105.8 level does make it much more likely that dollar strength extends further over the short term at least. On specific currency pairs, the move was most visible in the euro-dollar currency pair, which broke below the key 1.034 support level, again signaling further weakness was likely in the short term. This, of course, is consistent with our view to consider the euro as a potential funding currency, at least on short-time horizons. So overall, potential short-term trades in the euro as near-term dollar strength extends, and longer-term a shift towards bonds away from equities as a broader move that can help mitigate rising recession risks. Those are two investment thoughts I want to leave you with today. Just as a reminder, we will be keeping a close watch on the release of the Fed meeting minutes late in the US market day today as the next key macro event. So we'll pause there. As always, if you enjoyed this podcast, please don't forget to rate and like it. Thanks for listening and wish you a happy trading day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.